the asset class in general, and just let's say you compare it to multifamily, it's very fragmented. The data on exactly how many parks are out there, I've heard ranges from 36,000 to 60,000 communities total in the United States. It's difficult to build new communities, so there's kind of a fundamental supply and demand problem. And this is affordable housing.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network, CREPN Radio, episode number 124. This is a podcast focused on commercial real estate investment strategies. We do this through weekly conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Thanks for joining us. My name is J. Darren Gross. Today, my guest is Andrew Lanoie. Andrew is with Four Peaks Partners Capital, where they specialize in investing in mobile home parks. We discuss the marketplace and the opportunities that mobile home parks present. All this and more, but first, a couple of quick things. If you are on social media, reach out and let's connect. You can find me on LinkedIn, Facebook, and Twitter. You can look me up. I'm under J. Darren Gross. That's the letter J, Darren, D-A-R-R-I-N, Gross, G-R-O-S-S. When you do, please let me know you listen to the show. Also, remember, our goal at CREPN Radio is to learn and share. So if you like CREPN Radio, here are two things you can do to help us grow. And remember, this is the season of giving. So why not give somebody you know that invests in real estate or wants to get started investing in real estate, give them an episode of the show here. It's free. You can use the share button on your podcast player and share the show. The other thing you can do to help is to subscribe to the show. It's free. You can do this through either iTunes or Stitcher, and when you do, please leave a 5-star review. This really helps us attract new listeners and quality guests. And don't forget, if you're on LinkedIn, be sure to check out our group. You can join our group. It's Commercial Real Estate Pro Network. It's a great place to network with commercial real estate professionals. All right, let's get on to the show. Today, my guest is Andrew Lanoie. Andrew spent 16 years as a talent agent with the William Morris Agency, and along the way started investing in single-family homes. And today, he is the CEO of Four Peaks Capital Partners, which focuses on alternative assets. Andrew, welcome to CREPN Radio.
Hey, Darren. Glad to be here. Thanks for having me on the show.
I'm excited to talk with you. Before we jump into it, if you could share with the audience and myself a little bit more about your background. I gave just a kind of a brief sketch about your background. If you could fill in some gaps, that'd be great.
Yeah, absolutely. So I'm currently based in the Scottsdale, Arizona market. I grew up on the East Coast. I grew up in New Hampshire and had moved to Los Angeles about 20 years ago. And for those who have ever seen the show Entourage, which was the HBO series, I worked for a company which you alluded to, the William Morris Agency, for about 16 years. And so Ari Emanuel was my boss, and I worked with clients like Tim Allen and Whoopi Goldberg and Andrew Dice Clay and a bunch of different music acts like Peter Frampton and Styx and Joe Bonamassa and Blues Traveler, and had a pretty lucrative career there. It was actually usually when folks make it up the ladder and become an agent at the company, they become quote unquote lifers, and they're there for typically a long time. When the subprime crash happened, I had all of my money invested in the stock market and tied up in a 401k, and I think doing what most Americans are doing, and just kind of blindly putting their money in with an advisor, not really knowing exactly what exactly you're invested in, who's taking fees along the way, just really the Wall Street model. My folks had retired to Florida, and they had lost a chunk of their retirement savings. So, that along with being in what seemed like a pretty amazing career from the outside, but, in actuality, it was corporate America and, just all the negatives that come along with corporate America and backstabbing, et cetera. So really those two things were kind of my aha moment where I need to get my money out of the market and, I need to make a change in life. And I think usually, at least what I did in that situation is I started reading books, economics, and it kind of all really led me to real estate investing and how that really over time grew wealth for more people. And I think when you first kind of get the real estate bug, or you're reading about passive income and cash flow and all of that, you tend to look towards your backyard as well. Let me go look at some deals. And so even though at that point it was 2008, 2009, even in Los Angeles, even in California, the deals weren't really cash flowing. And I'm thinking to myself, well, I want mailbox money. I want passive income. Why aren't these deals cash flowing? And realize that obviously we all know California is very, very overpriced and just not that not that kind of a market or investment. So I started looking around. I found some mentors and started looking at other markets. And the first market I chose was Dallas, Texas. And once I kind of figured out, you find a market, you build a team, and you look at deals. And I think that instinctively sometimes people go the other way, where they find a deal somewhere and, they're not totally sure about the market and they don't have a team built. And sometimes that's when things can kind of backfire. So looked at a bunch of markets, realized Dallas, Texas, and this is probably back in late 2009, realized that Dallas, Texas was just a great opportunity and lots of jobs and growth and all the things that us real estate investors really like. I put a small team together and I started buying single family houses around I guess it was around 2009, early 2010.
So you got the bug. You were doing the single family homes down in Dallas. Sounds like you identified the market, you got your team, and you had a strategy, and you were doing that. How many homes did you end up acquiring?
Well, it was a lot. It started in Dallas, and I think once you really understand what your model is and how it works, I mean, it becomes pretty simple theoretically. And my model was, it's all about income. It's not about speculation on where the market's going or about appreciation. If things like that happened at the end, then fantastic. But it was really all about income. So if things didn't pencil out, then you simply move on to the next deal. So I was buying quite a few in Dallas, and then looked into the Memphis market. And Memphis was a big, strong market with lots of jobs and affordable housing. Started buying houses there. And then I actually bought my first house in Atlanta. I'm not sure what year that was, but maybe 2011, something like that. And Atlanta, which was really hit hard in the downturn, so there was a lot of inventory that once the arms readjusted in the subprime crash, that people just simply had to bail from. There was a lot of inventory, which overall really hurt that market. And I partnered with a few guys that I had met who were in Los Angeles, and they actually moved to Atlanta, and we started buying single families there. So really the majority of the houses that we bought ended up being in Atlanta. We did a lot of, and by the way, the model was really buy and hold, but we were doing some flips in Atlanta as well. So all across those three markets, it was over 100 single family properties, and it was about a 4-year time period.
So how do we get to Four Peaks? Was that did that come out of that, or are you still in the single family, or can you tell us how you got there?
Yeah, it's a great question. So sometime around 2013, the single families across the board seem to be getting really expensive, and the annualized returns were kind of dwindling. The market was getting overheated. People realized these were great markets to buy in. There were probably more and more REITs and hedge funds coming in, buying up big blocks. So I started to look around at different asset classes, and including multifamily, which I have a few friends that are pretty big operators in the space, and that seemed to be overheating. I mean, I still know some people who are in that space. They're just not, they're not buying a ton of stuff, and some aren't buying at all. So across the board, it seemed like a lot of residential, a lot of commercial was getting overpriced. And I had a friend who had purchased a few mobile home parks in the Midwest, and we sat down and had spent a while just talking about the model and what that looked like, and realized that was pretty compelling, and the returns looked great, and it was just a very different model. But single family is a wonderful asset class to cut your teeth on, but if you're really looking to scale and grow, it's tricky, right? Because you can certainly pick an area and try to scale that, but if you're looking for growth and economies of scale and everything like that, then it's hard buying one house at a time. So that was another thing that was interesting about mobile home parks and mobile home communities. So we took a really good look at the model and put a construction company together and a management company and the investment company. And about a month ago, we closed on 2 communities outside of Knoxville, Tennessee, and that now makes 15 communities and about 1,100 units that we have in the portfolio. We're operating in about 8 states and I guess 13 or 14 markets at this point, something like that. And funny enough, the last year we didn't end up buying that many communities, but what the real focus and attention went to was scaling the company and just spending a lot of time on team and how we're going to get to from A to B. And I brought on a few new partners, and one of my partners, for example, a guy named Mike Ayala, who Mike's background is he owned about a couple hundred units and 3 or 4 parks in Nevada, and he also owned a plumbing company that he ran with 110 employees for years, and he had a cabinetry company and construction company, and very, very much an entrepreneur, but he was really operationally a rock star. So he's someone that I've been talking to for a while and brought him on as a partner about a year ago, which has been just amazing. And another partner we brought on was Mauricio Raoul, and Mauricio was my good friend and securities attorney for the last 7 years or so with all the other real estate and projects I was doing. So, it was time to just kind of take a step back and build out the team and really work on systems and processes. And, we're also a virtual company, so it's amazing because we can really find great talent anywhere in the country, but it also presents challenges because you're not necessarily in a brick and mortar situation every day. So that's really been the focus was take a step back before we really move forward.
No, I hear you. I was just sitting there thinking as you were talking there, in the single family approach, you had spelled out that, hey, look, start with the market, and in the market you build a team, and then find the deals. And it almost sounds like with the not the multifamily, but the mobile home parks, your approach. It sounds like rather than market first, did you start with the team first? Is that kind of based on more of the virtual? Is that?
Yeah, it's a good question. I mean, really, it's with this because we can. The interesting thing is with operating in this many states. I mean, we're really working on clustering parks in areas. Like we're really focused on the Midwest into the Southeast. So we have multiple parks in Missouri and Kentucky and Tennessee and in those areas. The biggest thing, I think it goes back to the same mentality as single family, is the market has to make sense. I mean, there's got to be jobs there. I mean, it's funny if you look at a lot of small markets around the United States, like not the major metropolitans, but these small markets, a lot of them are in decline. And it doesn't mean that's a poor market to invest in. It just means you have to look at a number of different things, a number of different stats and data in the area to say, like, how far in decline is it, or is it growing? And if you're, just as an example, if you're looking in the state of Tennessee, if you look at an area like Nashville, that's a great market and it's growing and it's, everything's great about it, except it's really expensive. You go to a market like Memphis and you've got some great data and the price points are much less. You could almost compare that to Dallas versus Austin to some degree, Austin being another great market but really expensive. So you really have to put each market under the microscope, and we've got a full, a few folks that all they do is really look at deals and study markets, and we can make a pretty quick analysis of, hey, this is interesting. Let's take a deeper dive on this specific market.
Got it. And so now that you've got your team and you've got your markets that you're focused on, or that you're currently in, it sounds like you guys could go just about anywhere if the market was right and the opportunity was right. Is there a strategy within the mobile home park investment? I mean, I'm assuming you're looking for some sort of an opportunity to make more than what the numbers are showing, but is there any kind of a step-by-step process you guys take the park through, or?
Yeah, absolutely. I mean, a number of things. The asset class in general, and just let's say you compare it to multifamily, it's very fragmented. The data on exactly how many parks are out there, I've heard ranges from 36,000 to 60,000 communities total in the United States. It's difficult to build new communities, so there's kind of a fundamental supply and demand problem. And this is affordable housing, so it really falls under, our lot rents are anywhere from $200 to $300 and change. So we're absolutely right there in the affordable housing space. But to your question on the market or the asset class being so fragmented is you have a lot of legacy sellers who have owned that community for years and years and years, and they may just be up there in age. They might have some health issues. This might be their only asset, and they're just looking to retire, and they might live out of state. They may be actually the manager at the park. I mean, it's a number of scenarios, but a lot of the times if you run across a community that's at a lower occupancy, and that's been a lot of the communities that we've purchased have been, let's say sub 50% occupancy, barring something in the market, which we know how to really identify. It's usually an operational issue. So it's the owner running out of money, or again, it's a health issue and they just, they lose control over the park over years. I can't imagine a scenario where, the park one year is at 90% occupancy and the next year it's at 40% occupancy. And usually those things, take time, and there's a number of things that happen. So that presents a big opportunity. And on the other side of the coin is we found some interesting deals in the communities that we just purchased outside of Knoxville. We're actually at 89% occupancy. And for those who are tracking cap rates, we're buying things typically from about 8 to 12 caps. That was, I think, 11.5 cap, 89% occupancy. And there were a lot of park-owned homes in that community, which a lot of lenders won't finance. So that's another hurdle. So, and also on that community is the rents were below market considerably. So there was a little room to grow in occupancy. The rents were certainly well below market. And there was also a park-owned home hurdle to overcome. So it's like, it's like any entrepreneur or business owner. You look at your model, or you look at what you're doing, and I guess the more problems you can solve, then the more opportunities you can potentially work on.
So is the main one, and this is kind of interesting because I think this is the golden opportunity, if you find it, is the fragmented market where there's not any kind of uniformity to where if you can get in there and scale, you can put some systems in place and take advantage of that. Is that a big part of what you guys are able to do?
Yeah, absolutely. And it really boils down to we see the same issues over and over, and whether it's just simply it's an occupancy issue or having rents below market and having open spaces. That happens across the board at most of these value add or distressed or however you want to label those communities. We partnered. Warren Buffett has a few companies in this space, and one is Clayton Homes, which is the largest manufacturer in the U.S., and the other is 21st Mortgage, who they have about $8 billion out on outstanding loans on manufactured housing. So we partnered with them earlier this year, and we can order new homes, and they'll finance some of the homes that we're renovating. So that's just another way to solve those problems and fill those units. And that happens across the board. It doesn't matter if it's in Missouri or if it's in Arizona or if it's in North Carolina. Those are generally, those are all scalable, the same systems and processes. So it's been interesting.
So let me ask you, so are you guys actually owning the home and renting the home as well, or are you basically putting the home in and then selling the home?
Yeah, each time we buy a community, there's generally what they call, and I mentioned it earlier, they call them park-owned homes, and that basically means those are homes that were part of the deal, whether it was a separate transaction or not, but part of the deal that they could have a renter in them, or it could be just simply a home that does not have a resident in it, and maybe that home needs to be torn down because it's in such poor condition, or maybe it needs to be renovated. Ideally, in our model, the residents own their own homes. Part of that is through 21st and Clayton bringing in new homes and financing the homes that we renovate. There's some companies out there that are doing the rental model and different variances of it, and we're looking at it, but by the residents owning their own home, you've got a lower expense ratio overall. And I'd say just as important is it's more of a pride of ownership. So you've got, I think if anyone's owned real estate, they know that generally owners treat their property better than renters. So, if you've got a bunch of renters in the park with not very much skin in the game or a deposit in this asset class, in this demographic, they can do some damage. And so if someone actually owns the home, or they have, a couple $1,000s into the deal and they're financing it, they're, I think, less likely to, just simply move in the middle of the night. I mean, some of these folks, unfortunately, are, they're a car accident or a large medical bill away from having a hard time paying their bill. So, I mean, all that gets factored in. But the long answer to your question is we really like the resident-owned home model for a number of reasons.
Is there a benchmark? I mean, when you look in like you mentioned the market analysis, and you determine there's jobs, and is there a number you guys look for, or a percentage of like a median income, or is there any kind of a recipe there that you guys use for analyzing what can be, or is that same as what it is in other asset classes, or how do you do that?
Yeah, we definitely look at everything, and you want to, you're looking at not only, what condition or which direction the market is going in, but you're looking at what the median price for a single family house is. You're looking at what a two-bedroom apartment's going to rent for. And so it ends up being a blend of all of those things. You're looking at, for example, if a resident in a mobile home community can pay a $300 month lot rent, and they can also own their home for another $250 or $300 a month in a payment. So the lot rents never go away. They're always going to pay that as long as they're there. But that leasing, or the rent to own, or whatever you're calling it, that payment eventually gets paid off. If you're looking at $600, or let's just say $500 to $600 a month, typically these folks are not in the position to buy a house. They're probably not renting a house, and so really their only option is a two-bedroom apartment or some apartment, and you've got shared walls and all the things that go along with living in an apartment. Where in a manufactured housing community, you've got a little yard, and you've got your own home, right? Your own home, and you're not sharing walls, and some pride of community.
Right. No, I was kind of curious on the comparison there. Given the division there of the rent. I mean, there's a lot of rent versus the home cost or the home rent or whatever. So that's I'm sure your model, you have to take all that into consideration there. So that's good. So are you guys actively looking for investors in your fund, or are you basically capitalized looking to deploy, or where are you at in the?
Yeah, I think as of today, we're pretty well capitalized. We're always talking to new investors, and we're always creating different investment vehicles and funds, and we have our own lending fund. As an example, that just simply is there to create mortgages for residents coming in to help fill occupancy and help fill spaces faster. We've had several acquisition funds. So currently, we're really not looking for anyone, but we're actively talking to new investors because we have new funds that are coming out probably every 30 to 60 days, depending on the time. So, and a lot of my job as the founder and the CEO is really talking to all of the new investors coming in, because I want to make sure we're in alignment and it's a right fit for them, and vice versa. So that's a big part of my day-to-day.
Got it. In these parks, is this a long-term hold, or is there a kind of a strategy for liquidation, or?
Yeah, some of it almost depends on the acquisitions and what the model was. We have some that we're in for really long-term holds, where we're not really seeing selling those for 5, 10 plus years. We have other ones where we've modeled out for 3 to 5 years, whether it's a different fund or a different tranche of money that takes that out. With generally investors, they typically want, they want some certainty of an exit. So if you say to someone, hey, we're going to go into this and we're just going to hang on to it until we feel like, well, generally that doesn't work, especially if you're in the syndication and you're aggregating investors. So generally we need pretty specific exits.
Got it. Well, what's one thing that you've learned in your kind of your investments over the years? And I guess what I'm thinking is going from the single family into the multifamily. What's one takeaway that you look to and you think, this is the one thing you have to stay focused on?
Yeah, I mean, I'm struggling between whether it's team, which I think is paramount, or being flexible with your approach. So, as an example, when I was buying single-family houses, once they stopped penciling out, when I was looking at the numbers, I just simply stopped buying, right? So I think people get an emotional attachment to certain things.
Before we wrap this up, what is the best way for listeners to find out more about you or get in touch?
Yeah, absolutely. Probably the best way is our website, which is 4peakspartners.com. It's all spelled out, so FOUR peakspartners.com. There's a lot of information. We've got some pretty good reports and newsletters and things like that. We try to stay pretty active with communicating with our investors and our list. So that's probably the best way.
Got it. Andrew, I've enjoyed our talk, and I hopefully will be able to do it again soon.
Yeah, thanks so much, Darren. Appreciate you having me on the show.
All right. For our listeners, if you like the show, share the show with someone you know. It's easy to do. You can use the share button and share Andrew's story and investment advice you've heard here. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network, CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.